ready to level up your trading game. Today, we're diving deep into the world's leading derivatives marketplace, the CME Group. Forget random stock picks. We're talking about professional-grade tools for serious traders. Whether you're a seasoned pro or just starting, this guide will give you actionable strategies to navigate futures and options like a champ. So, what exactly is the CME? Think of it as the ultimate financial supermarket. You can trade futures and options on everything. Stock indexes like the S&P 500 and Nasdaq, interest rates, agricultural goods like corn and soybeans, energy like crude oil, metals like gold, and even foreign currencies. These markets are open nearly 24 hours a day and are incredibly liquid, which means you can get in and out of trades easily. But here's the key. Not all products are created equal. You've got full-size contracts, E-minis, and even micro-E-mini. A micro-E-mini S&P 500 contract is a fraction of the size of the standard E-mini, making it perfect for smaller accounts. Choosing the right tool is the first step. You wouldn't use a sledgehammer to hang a picture frame, right? Same logic applies here. Pick the contract that matches your account size and risk tolerance. Before you place a single trade, you need to answer one question. What's your style? Are you an investor looking to hold a position for weeks or years? You might use longer-dated futures to hedge your portfolio or express a big-picture macro view. Or are you a swing trader, aiming to catch moves that last a few days to a few weeks? E-mini and micro E-mini index futures are your best friends here. And for the adrenaline junkies, the day traders and scalpers, the high liquidity of CME products lets you capitalize on tiny price movements within minutes or hours. Even institutions use these tools, trading complex spreads to manage risk. Your time frame dictates your strategy, so define it first. Let's talk about the bread and butter. Directional futures trading. This is the simplest strategy. You think the S&P 500 is going up? You buy an S&P 500 future? You think oil is headed down? You short an oil future. The beauty of futures is the leverage, which can amplify your gains, but also your losses. That's why you must have a clear reason for your trade maybe. It's a technical pattern, a big economic report, or a geopolitical event. And always use a stop loss. But the pros often look beyond simple direction. Let's get into spread trading. This is where you trade the relationship between two contracts. A calendar spread, for example, involves buying a near-month contract and selling a far-month contract of the same asset. These trades are often less volatile and require less margin than an outright position. You can also do intercommodity spreads, like trading the price difference between gold and silver, or the crack spread between crude oil and refined products like gasoline. Spread trading is about finding relative value, not just betting on up or down. Futures are also a powerhouse tool for hedging. Let's say you have a large stock portfolio and you're worried about a market downturn. Instead of selling all your stocks, you could short S&P 500 futures. This acts as a form of insurance, offsetting potential losses in your portfolio. Futures are incredibly capital efficient for this because the margin required is just a small fraction of the total value you're re-hedging. Now, let's add another layer of sophistication. Options on futures. Options give you, well, options. They provide leverage with a defined risk. For example, you can buy a protective put option to cap your downside on a futures position, like buying insurance. Or, if you're bullish but want to generate some income, you could sell a covered call. This gives you extra cash in your pocket, but caps your potential upside. Want the trade volatility itself? If you expect a massive price swing, but do you know which direction, like around a big Fed announcement, you could buy a straddle. Conversely, if you think the market will stay calm, you can sell premium through strategies like credit spreads. Or options allow you to build positions with surgical precision, expressing complex views on both direction and volatility. Alright, let's get tactical. Here are a few high-probability setups you can look for. First, the breakout with confirmation. Wait for the price to break through a key support or resistance level, ideally with a surge in volume. You enter the trade, place your stop just on the other side of that level, and take profits at predefined targets. Another classic is in a strong trend, prices don't move in a straight line, they pull back. You can use indicators like VRP or moving averages to identify these pullbacks and enter in the direction of the main trend with a very tight stop. This is like buying on a dip in an up. For spread traders, mean reversion is also huge. If the historical price relationship between two contracts diverges wildly, you can bet on it snapping back to normal. Now, for the most important part, the part that keeps you in the game: risk management. This is non-negotiable. First, position sizing. Never risk more than a small percentage, say 1% or 2% of your account on a single trade. Calculate your position size based on where your stop loss is. Second, understand margin. Margin is not the cost of a trade. It's good faith collateral your broker holds. Know the initial and maintenance margin for your contract, and be aware that it can change, especially during volatile periods. Always have extra capital ready. And please use stop-loss orders. Define your exit point, asterisk. Before asterisk, you enter a trade and stick to it. This takes the emotion out of the decision. Finally, don't put all your eggs in one basket, especially if those baskets are highly correlated. Diversify your strategies and monitor how your different positions relate to each other. To tie it all together, let's walk through a few trade blueprints. Let's say you're an investor who wants to hedge 25% of your $500,000 stock portfolio. You could use micro E-mini S&P 500 futures. You'd calculate the number of contracts needed to create that hedge and then short them. You'd monitor the position and rebalance it periodically. Or a commodity spread trade. You notice a seasonal tendency for the WTI crude oil spread between the front month and a later month to narrow. You could enter a calendar spread to capture that move. The margin would be lower than two separate trades, and your risk is the spread itself, not the outright price of oil. Before any trade, run through this checklist, confirm the contract, spec stick value, expiry, trading hours. Know your margin requirements. Define your stop loss, target, and max risk in dollar terms. Make sure the contract is liquid enough to avoid slippage. And if the strategy is new to you, paper trade it first. My final advice: start small. Micro contracts are perfect for this. They let you learn the ropes with real money, but without risking your entire account. Treat these products as the powerful tools they are, and choose the right one for the job. And never stop learning. The CME itself offers a wealth of free educational resources. Use them. Master the discipline. Refine your edge, and you'll be well on your way. Thanks so much for watching. If you found this guide helpful, do me a favor and hit that like button and subscribe for more deep dives into professional trading strategies. See you in the next video.